The gold price edged back Friday, but held on to this week's rebound as the US Federal Reserve's sudden pivot to projecting interest rate cuts for 2024 and signaling that recession is now a greater concern than inflation was followed by mixed economic data. Rebounding by 1.2% in US dollar terms from last Friday's 3 p.m. benchmarking auction, the gold price today held $13 below 1st December's record weekly finish in London of $2,045 per troy ounce and $1.35 below the record daily PM fix of the 6th of August 2020. Both the UK gold price in pounds per ounce and in the gold price in euro terms meantime rallied back to last weekend's levels at £1,602 and €1,867, respectively, jumping less than the dollar price after the Bank of England and European Central Bank repeated their mantra of higher for longer on Thursday, rather than signalling 2024 rate cuts like the US Federal Reserve did on Wednesday. Over 75% of betting on March 2024's interest rate decision from the Fed now sees the US central bank starting to cut dollar interest rates in 3 months' time, up from below 1 in 4 at this point in November. For 2024 as a whole, almost 2 in 3 positions now foresee 5 cuts or more by the end of next year, with the consensus bet pricing a December policy rate of 3.92% versus today's 2-decade high of 5.33%. Compared to what the Fed itself now projects, and based on data from the CME Derivatives Exchange, only 1.6% of betting on December 2024 sees the Fed cutting rates 3 times next year to 4.60%, as per the median forecast of policymakers given in Wednesday's dot plot release. Markets are guilty of confirmation bias and will look through data to achieve that, says strategist Nikki Shields at Swiss Bullion Refining and Finance Group MKS PAMP. But maybe gold's move to new all-time highs on December 4th was a preview of this week's dovish pivot. Presenting this week's policy announcement and 2024 forecasts on Wednesday, we have seen real progress on reducing core inflation, said Fed Chair Jerome Powell. From here, and contrary to pundits, warning that the Fed now risks repeating the Burns mistake of the 1970s, cutting rates too soon and allowing inflation to rebound, we are very focused on not making the mistake of keeping rates too high too long, Powell said, signaling that recession rather than inflation is now the US central bank's major concern. While US retail sales beat forecasts for November on Thursday's data, and while the latest claims for jobless benefits came in below expectations, US industrial output failed to rebound as analysts forecast last month, new figures said Friday, with the decline in manufacturing activity deepening so far in December, while the services sector is expanding a little faster, according to the S&P Data Agency's preliminary PMI survey. The mixed US data didn't matter. The caution from other central banks didn't matter, says Shields. The Fed induced a pivot party and thus triggered an overreach for all asset classes at the expense of the dollar. Riskier and higher beta precious metals outperformed, with palladium up 12%, platinum plus 3%, silver plus 6% versus gold plus 3% from the eve of the US Central Bank's new 2024 outlook. While trading volumes in both gold and silver COMEX derivatives jumped by 16% on Thursday from the day before, volumes in NYMEX platinum futures and options rose 36%, reaching the highest since at least June 2020, and palladium trading leapt 2.3 times over. Silver today dipped back with the gold price, briefly slipping below $24 per troy ounce before reclaiming that level with a 1.8% weekly climb. Platinum on Friday trimmed its jump to 3.5-month highs, dropping back $20 to $946 per troy ounce, while palladium prices held firm near $1,150, more than 24.3% above last week's new 5-year low. So-called cryptocurrency Bitcoin, meantime, fell further from last week's 21-month high, while global stock markets trimmed this week's surge, edging 0.1% below yesterday's fresh New Year 2022 highs on the MSCI World Index. Looking ahead to 2024, this is where gold plays both hands. Shields at MKS concludes, it's a hedge against a Fed-induced recession that they see coming sooner, and a hedge against a Fed that hasn't won the inflation fight. Please like this video and subscribe to our channel.